Hello, and welcome to today's webinar, Should Investors Allocate More to China A-Shares? My name is Jonathan Massey. I'm a Senior Investment Strategist with Paragon Wealth Management, where we specialize in providing holistic wealth management solutions for helping clients navigate their way to financial freedom. Today, I'm excited to be joined by Dr. Jason Hsu, Chairman and CEO of Ralliant Global Advisors, and his cohort, Phil Wood, who heads the Investment Solutions Group. Good morning to you both.
Morning, Jonathan.
Hi, Jonathan.
For those who just learned about Ralliant, both Jason and Phil have extensive backgrounds in quantitative research, quite notably for their joint work on behavioral finance. Before coming to Ralliant, Phil was an assistant professor of finance at the State University of New York in Buffalo, where he pursued quantitative trading strategies and investor behavior, and he also taught investment management. He earned a Ph.D. from finance at UCLA and has spent the majority of his career in quantitative research. And Jason, he's published more than 40 articles and is a contributing author to 9 handbooks in finance and economics. He's won 2 Graham Dodd Awards, won the Reader's Choice Award, and won the Top Award. In addition, 3 Bernstein, Fabozzi, Jacob Levy Awards, 3 William Shaffer Awards, and he's regarded as one of the pioneers of smart beta investing. And in his spare time, he teaches finance at UCLA's Anderson School of Management. With that as an introduction, gentlemen, let's dive into what we're here to discuss, China. Phil, you and your colleague Nicole wrote an article for the Journal of Index Investing, and it explores a lot of what's on investors' mind this year. Should I start investing in China?
Yeah, the paper, you can find it online. It was published in the Journal of Index Investing. And really what we want to do in the paper is talk about some of the common arguments that people have made as to why it makes sense to allocate more of our portfolios to Chinese stocks. But we also wanted to take a critical look at some of the counter arguments, because there are certainly a lot of China skeptics and many reasons that investors avoid Chinese stocks. And so what we really wanted to do in the paper is take all of those arguments and the sort of skeptics' views, take those to the data and see how everything shakes out in sort of an evidence-based empirical analysis. And some of the arguments we found didn't necessarily hold water, but many of the arguments actually stand up to those tests. And so we were able to draw some sometimes counterintuitive, but I think generally interesting conclusions about reasons that investors might allocate more to A shares.
In terms of increasing that allocation, I think one of the big concerns as we allocate in tilt portfolios is, how should they think about sizing China in their portfolio?
Well, I mean, the very traditional argument has been, if a economy is large, whether it's by its market capitalization or by GDP, that you should give that economy, that market, more weight. And while that might sound intuitive, right? You want to think about, well, in a portfolio context, what exactly does that do for you, right? Why does giving more weight to a very large market, to a very large economy, why is that helpful to your portfolio? If you go back to the basics, right? Investing 101, really, when constructing a portfolio, size is not an issue, right? You think about, well, you want more return. So it's about investing in economies where the firms actually grow their earnings, and that translates into growth in long-term returns. Or hopefully you get both. You invest into an economy that's not very correlated with what you are currently invested in, right? These are the critical considerations. So when we looked at, if you give it more weight to countries that have larger GDP or are increasing their GDP, does that help with your overall portfolio characteristics? No, it has no bearing on either the risk or the return. What really matters are still the primary drivers, the growth of the underlying businesses, and they always translate into long-term returns or diversification benefit. And in this case, when you think about China, while it's large, the reason why you should have more China has nothing to do with the size of GDP. It's one of the few economies in emerging markets that have relentlessly and reliably translated its GDP growth into corporate earnings growth and into higher returns, right? It's one of the few economies that in the last 15 years that's actually grown faster from a corporate earnings perspective and has rivaled the US in terms of the returns that's produced. And more interestingly, it's one of the few large economies where you could really put to work in your portfolio that has enormous diversification benefits, particularly against the largest allocation in your portfolio, which is US. So I think the reason for allocating more to China has less to do with the size of China, but more to do with the fact that it's had wonderful corporate earnings growth and it's likely to continue to have wonderful corporate earnings growth. And it, for the time being, is still very uncorrelated with the rest of the world.
Yeah, I think I would add to that in terms of size. As Jason said, economic size or market cap wouldn't dictate the exact allocation you should have to a country like China. But I think we do see, in terms of the market cap of Chinese stocks, there is a big disconnect, and it's probably sort of too large to be explained by rational asset allocation decisions. A disconnect between China's market cap and the weight that it has in global benchmarks, most of which are based on equity market cap. So if you look at China's equity market cap as a percentage of global market cap, it's about 10 to 11% of global equity market cap. It's a $10 trillion market. It's second in size only to the US. But then when you look at the size of China in the MSCI All Country World Index, which is an index of developed and emerging markets, you find that it's only got about 0.6% weight in that index. And to put that in perspective, Apple, which is the biggest holding of the MSCI ACWI index, has a weight of 3.8% in the index. So Apple, which derives 15% of its revenues from China, has about 6 times more weight in the MSCI ACWI than China does. And in fact, if you add up all the A shares, there are 12 stocks that have more weight individually than all of the China A shares combined in MSCI ACWI. So, it's definitely underrepresented in the portfolios of investors who follow these global benchmarks. And I'll add one thing in terms of growth. So Jason mentioned the fact that there's this growth paradox, and we know emerging markets are growing really fast, but they haven't necessarily delivered stock returns commensurate with that growth. China is definitely the outlier in that respect, and we can take it a step further and we can break China down into onshore China and offshore China. And I'm sure we'll talk more about that. But when you look at growth, the corporate earnings growth is mostly coming from mainland Chinese companies. It's about double what you see from the offshore listed Chinese companies. And so with respect to growth, which is one of the reasons you'd consider investing in China, the benefits mostly accrue to the onshore listings, the A shares that I mentioned a minute ago.
And on the point of like the different share classes of China, it seems like 20 years ago, we only got access through ADRs and H shares of those traded in Hong Kong. And then, about maybe 6 years ago, we finally had access to onshore. Can you talk about kind of how we construct a well-balanced Chinese exposure in these allocations?
Yeah, so it's certainly gotten a bit confusing. There are so many different share classes of Chinese stocks. I think most US investors would be familiar with companies like Alibaba and Tencent. These are stocks that have listings in New York and Hong Kong. These would be what I consider the offshore Chinese stocks. We tend to think about Chinese stocks as falling into onshore and offshore. Onshore is the A shares. So these are stocks that are listed on the mainland exchanges in Shenzhen and Shanghai, and everything else, stocks listed in Hong Kong, H shares, red chips, P chips, and then the ADRs and stocks listed in Singapore. Those would all be considered offshore exposure. I gave a number on the size of China's market, about $10 trillion. That's the mainland stock market. The offshore listings are sized at about half that. So mainland stocks are really the greater share of Chinese listings. And as we discussed in the context of growth, there are big differences between onshore and offshore in terms of the benefits of accessing Chinese companies through these different listings. So I think while investors, as you said, they've mostly historically only had access to the offshore listings, and so they're more familiar with those companies, but it's actually the onshore market where, based on a lot of the arguments in the paper, we think investors should be focusing more of their attention.
Yeah, and then when you drill down deeper and look at what other firms are listed offshore, either as ADRs or as H, you'll discover that they're actually very heterogeneous. So you shouldn't think of the A and the H and the ADRs as being quite homogeneous as all Chinese companies who've just chosen different listing venues. So if you look at H, you think of Tencent, right? So you think, oh well, H is where a lot of the growth and tech names are. But no, that's kind of a sampling bias, because you mostly hear about that one company, right? By and large, when you look at the H, it's the mega cap state-owned enterprises, a lot of the banks, telecoms that were the first to get approval for listing in Hong Kong. And even as far as 2 years ago, by market capitalization, I would say 70% were state-owned enterprises. And of those that are listed in Hong Kong, over 50% by market cap again, or large financial institutions. So not what you're thinking about when it comes to sort of investing in China growth. And then when you look at ADRs, you might say, well, U.S. Stock exchange, it's more efficient, probably higher listing requirements, so better firms list in the U.S. Again, that's a misnomer, because listing requirements is actually very low in the U.S. You pay your listing fee, and off you go. This is why there've been a lot more publicly visible frauds reported for some Chinese companies listed in the U.S., whereas listing requirements domestic in China, whether it's the Shanghai or the Shenzhen Stock Exchange, are incredibly stringent and very difficult. You have to have profitability for a long period of time, and the stock exchange will audit you regularly. So it's oftentimes the firms that don't meet listing requirements that end up seeking listing in U.S., where at least up until more recently, they didn't have to have an independent auditor and didn't have to file their numbers. So that's only recently starting to change. So one shouldn't think, oh, all the stocks listing in the U.S. under ADR as Alibaba, right? That again would be a sampling bias. And finally, I would say, if you're thinking of where is the next Tencent, the next Alibaba going to come from, it certainly aren't these mega caps that have sought listing offshore. It's a lot more of the small caps, mid cap names that are onshore in the A's, where I think the growth opportunities truly are.
Fair point. In terms of opportunity, 20 years ago, China was kind of referred to as the factory of the world. But over the years, they have a massively growing middle class, trying to become more of an internal consumption-based economy. A lot of innovation, to the point of the tech names. How do you best tilt your portfolio to maybe capture kind of the new China, as opposed to some of these indexes, tongue-in-cheek, are focused on the antiquated old China and state-owned enterprise?
Yeah, so I guess I'll start and just mention that, as you said, there's a perception that China's economy, particularly if you think about onshore listed companies, that it's mostly manufacturing and really export driven. But there are a lot of interesting statistics that are sort of trending in a different direction. So looking at the number of unicorns, private tech companies with $1 billion plus market caps, 6 of the 10 biggest unicorns are actually Chinese companies. And China has almost the same number of unicorns as the US does. Last year, they had a greater number, and this year they've fallen below by 6 companies. So I think China would surprise a lot of people in terms of the transformation that their economy's undergone, much more internal consumption based, driven by tech innovation. And so, as Jason said, I think a lot of the exciting stock stories going forward and be coming from both the US, but also A shares that are very unfamiliar to US investors.
Yeah, and Jonathan, you're absolutely right to say that we have this old imagery of China, that was probably built from 30 years ago, and then we only slowly been updating that. If you visit China today, some parts, the tier 2, tier 3 cities may still be predominantly manufacturing, OEM manufacturing, and export oriented. But when you look at tier 1 or kind of top of the tier 2 cities, it's hugely domestic consumption. It's a lot of financial services that is geared toward serving the rising middle class in China. And in fact, if you look at just how little export is as part of its GDP, right? It used to be about 36% about 10 years ago, and it's dwindled down to half of that today, only 18%. And much of that's been sort of lower value add, lower margin manufacturing that's been pushed to Indonesia, Vietnam, India, Malaysia. So very much what we're witnessing today is a climbing up the value chain, the same way Japan did in the 80s, that Taiwan and South Korea did in late 80s and throughout 90s. So what we're seeing is the very same thing in China. I think the big difference there is the Chinese market is big enough, like the Japanese market. They're able to build a strong brand based off of a strong home-based demand, and that does, make it a very, very different story. Meaning, it's likely to be one of the few Asian economies that has the potential of mirroring the U.S. growth trajectory, right? Having just a big enough domestic consumption market.
Fair. In terms of like additional risks, here in the States, we use the VIX as our fear index, and over the long run, it's 20. We hibernate and we get explosive. Every 2 or 3 years, we get above 30. There's a China VIX that the CBOE, Chicago Board of Options Exchange, runs, and its long run equilibrium rate is 30. So our most stressful days here in the States are just your average day in China and some of these emerging markets. So how do you guys consider in terms of like factoring in that additional risk? Should these emerging market stocks be that much higher than developed? And if so, do we cut back that? How do we risk size our allocation?
Yeah. So, Jonathan, you're absolutely right. The fluctuation, whether it's the beta or the individual stocks, are just higher in China. I think 10 years ago, if you just measure sort of the broad market volatility, it's about 33%. It's gradually come down. I think it's now closer to the rest of EM, so at 25%. So there's a bit of a risk reduction as that market matures and gain depth. But certainly, it's a more volatile market and say a more risky market. And I would sort of break that down into a few dimensions. We think about what should investors do when facing a riskier market? Now, one, of course, is you want to make sure you're being paid the proper risk premium. And again, if you look at the valuation multiple for the broad Chinese index, so be it the MSCI or the CSI 300, it is definitely trading at a meaningful discount relative to the S&P 500, right? It's a riskier market, so it has a cheaper valuation multiple. And of course, part of that is then offset by the fact it's a faster growing beta as well. But at the end of the day, I think you want to ask, am I earning the proper risk premium? And when you ask that question and you compare the US, where the valuation multiple is at all-time high, you say, that high valuation multiple, is there more upside or is there more downside? And then you look at China and say, yes, there's more volatility, but it's at sort of historical median valuation multiple and perhaps a better growth prospect. Am I getting the fair risk premium when you think about this sort of relative comparison? So that'd be the first question I would ask investors to think about, which is, yes, it is more risk, but that's not in of itself meaningful, right? You want to think about, are you earning the right amount of risk premium? And the next risk I think most people think about when they think about China is perhaps not the fluctuation in the stock market, but really sort of these tail risk, right? Fraudulent event, right? They might buy a fund and a major position could go to zero because it's discovered to be a fraud. Again, that I think is a old imagery or unfair imagery because usually only frauds get reported. When Phil and I, when we look in the data, what we discover is, yes, there is systematic and quite widespread sort of accounting manipulation or earnings smoothing. And then we find that in all of emerging markets. What's surprising in China is the manipulation more than half the time, so more than 50% of the cases is to reduce profitability. So to mask earnings, essentially to pocket profits so that they could use that to smooth over a period of low growth in the future. So actually in China, it isn't just about finding firms that are committing fraud and hyping up stock prices. It's also discovered gems, firms that are much more profitable that are hiding their profits. And then a lot of Chinese banks are actually doing that. They're hiding their profits, pretending they have a lot of bad loans, just so that they could build up a big reserve to smooth over sort of future economic downturns. So that's something that I think it's useful for people to sort of update their imagery. That you actually have more firms who are more profitable than their accounting suggests. So they're quite conservative. And then I think there's another concern people have with the Chinese equity market, it being hugely SOE, 50% by market capitalization are state-owned enterprises. That's a big number. Mm-hmm. And of course, we think of state-owned enterprises as incredibly inefficient companies, probably a lot of fraud and corruption. And again, I would say, that's true to a limited degree. So if you think about sort of regional, provincial SOEs, sure, there's a bit more, perhaps sort of shady inside dealing, where the political appointees may skim off a lot of the cream from the top. But when you talk about sort of central SOEs, oftentimes you're talking about the A team from Beijing working on a turnaround, or the A team from Beijing working on what they believe to be sort of systemically important industries and the leader firms in that industry. So not only do they have sort of a lot of oversight nationally, have really good management, and they often face a lot of policy tailwind to help them succeed. So I would say, so these are the things that I would really encourage investors to spend time to find out more, because I think the stereotypical imagery we have about China as an economy and firms in that economy aren't accurate, or at least they're not the whole picture. And I think this is where you do want to partner with a good manager with a lot of local presence and local insight to get the full access to growth and alpha.
Yeah, and I would add on the risk dimension, there's another consideration. We spend quite a bit of time in the paper talking about it, which is thinking about China not in terms of the individual country equity market volatility, but thinking about it at the portfolio level. And how does an allocation to China affect an overall portfolio's volatility? And of course, that's going to depend on China's correlation with the other assets in your portfolio. And one of the great things about an allocation to China is that mainland stocks have extremely low correlation with other global equity markets. So looking at a 15-year sample, what we find is that China's correlation with US stocks is about 0.3. When you look at US versus developed ex-US, the correlation is 0.9. And interestingly, EM ex-China has a correlation with the US of 0.8. So most of the benefits of diversification into emerging markets actually comes from the China exposure. And there's another interesting aspect of that, which again gets to the difference between onshore and offshore China, which is that if you think that you can substitute the onshore shares for offshore China exposure because it's easier to access, or you're more familiar with offshore Chinese companies, it turns out that 0.3 correlation between China A shares in the US jumps to 0.6 if you're looking at offshore China versus the US. And so in addition to having a pretty favorable risk return trade-off, adding China to a global portfolio, you're getting immense diversification benefit. So this, for us thinking about asset allocators, this is one of the principal benefits to allocating to A shares on the risk dimension.
Sure. It's interesting, just all the different divisions of how to invest in China. One of the U.S. headlines recently is, so my fear as a listener would be, Rayliant makes a very eloquent case for China. I'm going to get going right away in my Schwab or TD account and start trading the ADRs. But the fear of the headline nowadays is a lot of these ADR investments will be banned or delisted. Like, do I construct a portfolio today only to have it delisted months from now? Any commentary on some of the headlines between the US and China investment?
Yeah, so I think the U.S. government's been sort of telegraphing that one. So I hope at least people who are buying the ADRs we're gradually looking to move them at least to the Hong Kong listed share. So some of the ADRs already sought dual listing have been approved, right? I think NetEase and JD.com and Alibaba are all now dual listed. Now, not everyone has gained approval for dual listing. So there is a risk if you're heavily invested in Chinese ADR that you will be left holding something that is essentially it does have a value, but it just isn't publicly traded. So you're going to lose a lot of the liquidity premium in your holdings. And again, that's something the U.S. government's been telegraphing for a long time. And I don't think even with Joe Biden coming into the office, that will be reversed immediately. I think his hands are a little tied. Given that he doesn't want to be immediately labeled as a more of a pro-China or being a softie on China on the kind of the first 100 days of his administration. So I would say anyone who's got ADRs in their portfolio, this risk is real.
Mm-hmm.
There are also unintended consequences. So Jason talked about listing requirements and how much more difficult it's been in China historically for companies to IPO. And so a lot of companies were incentivized to go to the US and list an ADR. With the threat that ADRs might be delisted, China has relaxed those IPO requirements. So what we're seeing is a lot more companies now thinking about listing in the mainland market. And the upshot for investors is that the mainland market is dominated by retail traders. And this is something else that we talk about in the paper. The fact that if you're looking for alpha, it's much better to be trading mainland stocks where your counterparty is an individual investor with no financial training than trading ADRs where, most likely you're trading against other sophisticated institutional investors. And so, some of these policy changes, they've got a political motivation, but they actually have these sort of unintended consequences for investors who are thinking about allocating to China.
And Jonathan, let me just sort of add one additional point because you're talking about risk and certainly geopolitical risk. The fact that increasingly, China and U.S. has gone from, co-opetition, right? Where there's collaboration, there's some competition, to probably more competition than collaboration. And I think, we saw that with Japan and the US when Japan was emerging as well. That may actually be status quo, at least for the next few years, maybe even for the next few decades. Now, that's not necessarily a bad thing. And I don't think as investors, our job is to pick the winner, coming out of that co-opetition, right? I think for us, we know, it's two different models, two different governments, two different markets, and both of them have great companies that can grow because they are leaders in the industry, leaders in driving forward the technology frontier. They have a large captive home base from the build margin and build profits and build markets. So you can imagine both systems can work and can thrive, can deliver long-term returns. In the short run, this co-opetition, especially the competition aspect as that emerges, just creates more diversification, right? They're going to be more negatively correlated. So in the long run, I think both markets are going to grow, and therefore they both deserve large allocations in your portfolio. But the fact that the U.S. and China are occasionally going to be expressing differences in opinions that results in tension, it's going to create a short-term diversification, right? They're going to be negatively correlated, even though in the long run they're both going to grow, and then that's just not a bad thing in the portfolio. I don't think as investors you need to be here, prognosticating and picking winners.
Very fair points. I know at risk we talk about tail risk, geopolitical, state-owned enterprises. We here in the States, there's a lot of resistance. We have these companies that are bigger than economies, and there's a lot of seemingly pushback in terms of investigating the monopoly side. And it seems like China has also been expressing their concerns with the size of some of these, tech mega companies. Any commentary on the U.S. involvement versus our homegrown tech behemoths versus China's recent resistance?
Yeah, so Jonathan, the one big, case study, and I think everyone's staring at it, is Ant Financial, right? That was supposed to be the biggest IPO globally this year. Because it's a dominant company, right? It's the unicorn of unicorns. They are the biggest payment processing. They in a way almost have a dual currency in China, where if you have Alipay, right, you almost don't need renminbi, don't need credit card. They're making loans. They're circumventing kind of the state-owned credit card companies in terms of facilitating microcredit. Probably getting into the mortgage space, really replacing the banks in China. And I think that's probably a little too much, too fast. It's it's enormous monopoly, and it's really taking the pie away from the big state-owned banks, and thus I think the Chinese government has asked the company to table its IPO as it sort through, does it break up this monopoly? Does it regulate this monopoly? So I think that risk is quite real, right? It's not just Jack Ma perhaps carelessly making a statement that irritated the policymakers. No, I don't think policymakers, and I know for sure policymakers in China are not that petty. It really is these massive monopolies that are starting to be very anti-competitive. They are just steamrolling over any and everyone, and it's not obvious in the long run that will drive more innovation and better services. So I think the very same thing that the U.S. is worried about, and that our policymakers are starting to pay attention to, and I think the Europeans are already acting on it ahead of the U.S. And China is just, I think in this case, a step ahead of the curve in terms of putting its foot down and saying we got to regulate this, and maybe we got to break it up.
And along those lines, there's a common perception among investors that China, that the state is very heavy-handed in terms of their interventions in the market. And this is something Jason's written about recently on defaults in China among SOEs. So state-owned enterprises, which historically have had the support of the government, and often they're heavily subsidized and they're bailed out when things don't look so good. Recently, there have been more defaults among state-owned companies. And so in many ways, even though events like the Ant Financial IPO suspension get headlines, what we've seen over time generally is that China's interventions have actually been decreasing. And a big part of that is, they know what they need to do to keep the global benchmark providers happy, and to keep getting bumps in the inclusion factors. They basically need to take a more hands-off approach, and not suspending stocks, and not doing as much of this sort of national team support for the market. And so I think the general trend is toward less intervention, and that should give investors comfort when they're considering allocating more to China.
Very fair. I do want to ask one question on kind of the general conversation before we get to the Q&A, but any comments? Again, it seems like, for better or for worse, the indexes do a okay to good job with their, market cap weighting and their adjustments to the investability factors. But there's the big criticism of indexing becoming too big. Do we see that in China? And if so, what are the opportunities or tilts that investors could seek to kind of opportunistically exploit some of these risks or concerns we've talked about?
Our complaint about S&P today is it's almost all tech, right? And the biggest name, biggest weights are all tech, which of course, is reminiscent of 1999 when the S&P was all tech, and so people are starting to feel froth and a little scared for good reasons. Now, when you look at the Chinese passive index, the complaint is similar but different. It's similar in that the index is dominated by the state-owned enterprises, particularly the big insurance companies, the big banks, and the big brokers. And then so those are not your growth technology names, but there's certainly a concentration that not everyone is excited about, right? When you're thinking about investing in China, you want the growth companies. You want the next guy who might be your Alibaba and your Tencent, right? So there's equal dissatisfaction with how the passive index is constructed, too SOE heavy, too financial heavy. And when you think about, okay, well, can you do better? And what's the prospect for adding alpha on top of that? We got to go back to the principle of investing, right? If you want to earn alpha, it's a zero-sum game. Someone has to lose alpha, right? And so in the US, it's hard to gain alpha because, well, it's all institutions, right? The other side of your trade is probably Renaissance technology, and that's just bad news for you, right? Or the other side of your trade is the Goldman prop guy, and that again is bad news for you. But in China, Phil's mentioned, the other side of your trade, 80 to 90%, it's a uninformed, not very disciplined, not very experienced trader. Just to give you some statistics, year to date, there's been about $1 trillion in new money that's been funded into discount brokerage accounts in China. So it's a lot of new money coming online, and there's been about another 1 trillion in margin, right? That's being utilized by these inexperienced traders, and that's your alpha reservoir, right? We're not seeing retail individuals losing and exiting out of the market, right? So we're not seeing the U.S. Where retail is now an insignificant part of the market because they just can't compete against institutions. In China's been steadily 80-90% retail trading. New account openings are record high this year, and so we don't see the Chinese market as sort of converging to US anytime soon. And in fact, as long as there's so much sort of retail participation, we expect the alpha opportunity to be just as large now versus what we've seen in the historical sample. So definitely, I think from a zero-sum game perspective, if you're an active manager, you're an active investor, you're looking at alpha in addition to getting some uncorrelated beta. This is another point in favor of accessing the onshore A shares and accessing China.
Very fair. Before we go to the Q&A, any parting points that maybe you guys wanted to, any points you want to kind of drive home as we go to the Q&A?
Yeah, I guess now that we've sort of come to the subject of how exactly you should invest in China and passive versus active, there's another element to the approach that we take at Ralliant, which I think is really important. So in addition to recognizing that in China, it's really this large pool of retail traders that's generating a sustainable source of alpha. So a big part of the strategy is thinking about investor behavior. When 90% of investors are inexperienced and they're sort of falling back on heuristics and common sense in terms of the way they make investments, behavior becomes really important. And so thinking about the types of behavioral mistakes that investors are prone to making and using that knowledge to figure out where mispricings in the market are most likely to occur, that becomes really important. But the second piece is acknowledging all of these differences. So in the course of this discussion, we've talked about a lot of unique features of China's market, in terms of the segmented nature of the market, state ownership, and thinking about differences in accounting, differences in regulations. And all of those things create frictions that can be an impediment to generating alpha, because it means that some of the strategies that an active investor might deploy in developed markets like the US, they might not work the same way in China. So, part of it is sort of adjusting the way that you invest to those unique market conditions. But these differences in China versus other markets, they also create completely new opportunities to generate alpha. So a lot of what we do on the research team at Ralliant is trying to uncover interesting data sources in China. And Jason touched on a couple of those. I mean, one of the things we're looking at is companies, managers, political affiliations, and trying to figure out, as Jason said, are the managers of a company nationally connected, and is the company more likely to receive political favor, or does the company have a bunch of low-level local connections, and these sort of local political bosses are just expropriating from shareholders? We look at data on retail investors where we can directly observe what they're trading, and we can figure out which stocks are being overpriced, and on the flip side, which stocks retail investors in China are overlooking and might be a bargain. So a big part of the strategy is what we call localization, which is basically trying to turn these unique features of China's market in our favor and capitalize on this alpha source that's really tailored to China's market.
That said, we'll go to the Q&A for the next 10 minutes or so, but we have a comment about the accounting in China is In China, a big issue still appears to be the rule of law and accounting fraud. I get that correlation and higher growth rates are important, but I worry about the credibility of earnings and accounting fraud. How can I possibly get over this hurdle?
Yeah, so when it comes to accounting, it's clearly a concern that investors have. And generally, when we study China, what we find is that a lot of the concerns that investors have when they think about allocating more to Chinese stocks, when it comes to accounting or state ownership or anything else, they're valid concerns. Now, the question is, should that keep you out of China's market, or is there a way to turn those challenges into a big opportunity? And retail investors in China, they're just as fooled by the accounting frauds as anyone. And indeed, that's why companies will engage in earnings management or manipulation. It's because they know that they can fool investors and profit by it. But we don't have to fixate on companies' reported results or, look solely at net income. We've got hundreds of accounting items. And if you understand China's accounting standards, it's possible to identify suspicious behavior, sort of looking for inconsistencies in that big array of data that we've got. There are also all sorts of other data sources that we can look at. So interestingly, in China, one of the ways that companies manage their earnings is not by cooking the books. They just secure big state subsidies, and they can sort of mask a loss-making business by getting support from the government. Of course, that kind of subsidy-based earnings management exposes investors to a lot of risk if the subsidies get cut off. And so subsidy revenues is something that we track. There's another really interesting data source, which is looking at the investigations that the exchanges in China make into companies. So it turns out at any given time, hundreds of companies are being investigated by the exchanges, and the exchanges publish the results of those investigations on their website. So one of the things that we do is scrape those websites, and certainly knowledge of a pending investigation, that's important. And they actually publish the results of these investigations. And it's basically a team of very skilled Chinese forensic accountants digging into companies' businesses. And so reading through those reports, we get all sorts of ideas about new data and sort of systematic ways that we can identify accounting fraud. So it's a huge concern, but if you've got expertise in China, it creates an opportunity to really sort out the good and the bad actors. And because investors are afraid of accounting fraud, they heavily discount companies that present, good opportunities for us.
Sure. Some other questions on a risk we haven't talked about is, and I'm going to combine a few of these Q&As, so forgive me, those who are kind enough to take the time to ask these individually. But they're asking about what percentage of the returns come from currency fluctuations. I'm guessing it may be limited because of the peg, but any comments in terms of, the former administration labeling China currency manipulator and how that may affect global returns?
Got it. So, China definitely manages its currency, and that shouldn't surprise anyone if you look more broadly at all of Asia, Hong Kong included, South Korea, Taiwan, Japan. The central bank makes it as one of its key mandates is to ensure currency stability. And oftentimes it also means when they're struggling economically, that they will cheapen their currency to help out export, but also when they realize that they're exporting too much and they need to be much more domestically focused to fuel domestic consumption growth, they will allow the currency to appreciate so that they can sort of, stem export and focus more on, domestic production and importing. So yes, there's definitely currency management. So let's not be surprised by that. And if we want to call it currency manipulation, I guess that may mean the same thing, but perhaps just not as sort of evil in its intent. Okay, so we want to think about currency fluctuation. The renminbi currency fluctuation is probably any given year, so sub 10%. So, relative to kind of the long-term stock market return of 10-15%, that's certainly meaningful, but it's definitely mean reverting, right? It's got a slow positive trend because there is a trend for Asian currencies as they emerge from emerging to develop. There's just historically for all these markets, a appreciation in the currency. right? As you have higher standard of living, as you become more productive, as you're more globally connected, your currency become that much more valuable because people want to buy your goods. Your currency has value. The claim to the underlying assets has value, and that's no different for China, right? China's gone from 12 renminbi to $1 about 25 years ago, to 10 years ago 8 to 1 to now 6.5 to 1. So it's been on a gradual trend of appreciation. So the claim of Chinese manipulating its currency downward to have an unfair advantage over the U.S. That's just not borne out by data. If you look at the data from the last 25 years, right, its currency has steadily appreciated. Its export to the U.S. has gradually declined from 36% to 18%. So if you're worried about currency, my guess is, in the short run, there's fluctuation, and I can't forecast where renminbi is going to go. But in the long run, again, if you look at Japanese yen, you look at Chinese dollar, Korean won, the trend is definitely on your side in terms of holding RMB denominated assets.
Sure. In the interest of time, I'm going to try to combine some of these last bits. So David K, Iris, and LaQuinn, my apologies if I blend this too much, but one question is with the possibility of privatizing assets in China because of the government control. And then the other end of the spectrum is, of the ones that are, partially government control, how much of a detraction is that? One person specifically comments that the A share markets have made such a run. What's the reversion possibility? So again, securitization, privatization, and some more commentary on the performance of A shares and SOEs.
Okay, well, I'll tackle maybe the first two, and Phil can prognosticate on the future of A shares. So if you look at privatization, there are really two kinds of privatization going on in China, and it's not the Russian kind. So the Chinese government has listed basically all of its state-owned enterprises over the past 20 years, right? And it's listed rather than sort of privatize. Now you can say, well, that's the same thing, right? But privatization is like you run a government auction and you auction off valuable government asset to your cousin, right? That's usually what we think of the Russian privatization, and we're not so fond of that because that doesn't lead to market efficiency, right? It builds a class of oligarchs that's not particularly healthy. China actually just lists its own state enterprises, float the shares, let everyone participate, and some people participate because they feel like, well, the Chinese government will at least secure the downside to make sure these firms don't go out of business. So I got some downside protection, maybe not a lot of growth. So there's sort of good demand from their retail individuals who will buy these shares, but certainly not being sold at unfairly cheap price for basically, for fraud or corruption purposes. And so the other privatization that's far larger and has a far larger impact on the economy, where one could argue whether that's done well or not, is really the privatization of land, right? Obviously, the government owns almost all of the land, and it sells these very long-term leasing rights to land for real estate development. It's certainly brought a lot of development, a lot of prosperity. The real estate sector is huge in China. Can that continue? Can that continue to be a driver for economic growth, given that so much of the land has been sort of released or leased out for development and perhaps even overdevelopment? So that is a big risk, and that is something that all of us continue to watch, right? Because I think the real estate sector has sort of stagnated for about the last 5 years now. It's been the previous driver, but the good thing is you're seeing sort of new economic driver, technology, consumption sort of taking over, and the more it takes over as the driver of GDP and income growth, the more I think the Chinese government can sort of wean itself off of land privatization.
All right, so I'll take the last part of the question. Just thinking about valuations in China and the amazing run that China's market's been on in 2020. Of course, China was the first to get hit by COVID-19, and their economic rebound has been impressive. They were very early to get the virus under control, and with that rebound, the market has rallied. So Chinese stocks are up about 15% this year, depending on which benchmark you're looking at. We've done a lot of research on this rally because we sort of wanted to understand what's driving it. Given that it's a retail dominated market, there's always a concern that it's really individual investor over exuberance, and we might be seeing the formation of a bubble. So we've got some research on Railiant's website that goes into sort of breaking the rally down into different features, looking at the fundamentals, looking at how retail investors are participating and really driving part of the rally. And then also thinking about corporate insiders. So insiders selling shares, companies doing securities issuance. And it looks like, the current rally, it's got some similarities to the big bubble that we saw in A shares in 2015, although notably valuations aren't nearly as high as they were in 2015. We've certainly seen segments of the market that appear frothy. So looking at growth stocks in China, we see a situation that's similar to what we observe in the US. And so in certain pockets of the market, there's cause for concern. But for active investors, these sorts of dislocations and retail investors getting really excited about different segments of the market, again, just tends to create opportunity if you're able to sort out the bargains from the overpriced growth stocks.
Great answer. And there's been a lot of questions coming in about the pricing of the A's versus H's. So I hope those who asked those questions, that was addressed in that last one. Just in the interest, I'm going to wrap this up. It seems like no continuing education event is complete without the final question of ESG screening, risk or opportunity. Any comments on the environmental, social, or governance happenings in China?
Well, I'll take the easy one. On the governance angle, governance has been a factor that add to more return in most of the emerging market companies, and it's no different in China. Investors in China simply underappreciate the value of good governance, shareholders' right protection, diversity in control, independent auditing, that's all good for long-term stock growth. And so we see that in spades in China, and certainly as we're helping our investors, whether they believe in ESG or not, they really need to have governance in their portfolio.
Yeah, and just adding on in terms of the E and the S, and just maybe thinking about ESG more generally in China. On the one hand, there's a perception that that maybe ESG in China is difficult because of a lack of data, but actually there's quite a lot of data available, particularly in the last few years. China's been really serious about companies reporting on ESG. There's a lot of external reporting that's done. So we're just swimming in data in terms of ESG indicators in emerging markets, but in China specifically. And then in terms of applying ESG in China, there's also, I think, a notion among investors that that maybe China is not so great on some of these ESG dimensions, and so maybe it doesn't make sense to invest in ESG in China. But we've got sort of a different way of looking at it. We think that for investors that are really serious about ESG, it might make the most sense to apply ESG investing where that's most likely to have the greatest impact. And certainly the countries that have the greatest ground to cover as they improve on ESG, that's where responsible investing can have a really strong effect. And so for some investors, I think that's a good justification for targeting a country like China in their ESG investing activities.
Very good. Well, again, gentlemen, thanks so much. And all those on the chat, thank you very much. The questions were fantastic. Hopefully I got to as much as I could. I really enjoyed the Q&A. If I did miss anything, before we sign off, I want to encourage you to reach out to the team at Railiant. If there's anything that went unanswered or comes to mind later, you can reach them. I put this in the chat to send your emails to insights@railiant.com. Again, hopefully you all found the discussion as informative and engaging as I have. The Railiant website has the most recent white papers and the Journal of Indexing articles. Please reach out to them and visit their sites. Lastly, if you have any feedbacks to share with any on today's session, there'll be a short survey at the end. I would certainly appreciate any comments, criticisms, general feedback and all. So Phil, Jason, always a pleasure. Team at Ralliant, thanks so much for putting this together. Us folks at Paragon are really excited about the opportunities in China and continuing our collaborations. And to all, have a safe and happy holiday season. Be well and stay safe.
Thanks,
Thanks so much.
thanks, Jonathan.
Very good.
Thanks, Jonathan. Thanks, everybody.